This is Natalie Pace, and thanks for joining me today. So, where are stocks headed? Will 2025 be as magnificent as 2023 and 2024, which of course was all about the Magnificent Seven? Or, we've seen Tesla go down by 30%. And can Nvidia maintain such lofty valuations? All this and more, including some areas that we may wish to underweight when I speak to an industry expert. He's been at it for over 50 years, Howard SilverBlatt, the senior index analyst of S&P Dow Jones Indices. You may know it as the S&P 500, also the Dow Jones Industrial Average. All right, we'll get started with him momentarily. Remember to subscribe here, or if you'd rather listen as a podcast, go to substack.com. Again, Natalie Pace on both channels. Okay, Howard. So I'm so grateful for you to join us. And I already did the introduction, but if you want to tell us anything about your illustrious career, feel free to do so now.
I'm still on probation after 48 years. What can I say? Uh, if I had to find some words of wisdom, which I don't have, it's that the biggest change has been communication.
Ah,
Uh, we came in, you probably remember, you got things off the Reuters or the Dow, and it came off the wire, and that's how you found. Today, if
yeah,
something happens half a world away, I am on my cell phone and I'm watching it live.
right.
So communications is really the biggest difference, I think, over at least my career. And obviously that translates into the market moving right away. You used to be able to do arbitrage between New York and Philly. Now you can't even do a yen in Japan.
Yeah.
Uh, Everything is starting out, all the systems, whether it be a computer, AI, data computing, you're starting out with research that used to take us weeks, if not months, to do. And you needed a staff.
Yeah. It's
So
interesting. So I mean that leads us into the question. I mean, we've had two fantastic years, 2023 and 2024. And honestly, we didn't really expect it, right? Nothing of this magnitude, did you? Or
No, and if you recall, going into 24, the only surety was that if we were lucky, we'd get 3-4%, and that the Magnificent Seven were going downhill.
oh boy. Well, the Wall Street teaches us all, right?
Yeah,
What
keep us humble.
do you have any, or dare you do a prediction for 2025?
Yeah, I mean, I base it on the fact that I believe the economy's not only strong now, but after we figure out whatever is going to happen with tariffs,
Right.
and associations and employment, unemployment, that while the economy may not be as strong, hopefully it'll be more efficient, uh, it'll continue on. And that will keep earnings. My difficulty with putting the actual number on how much I think we'll be up this year, which means I don't see a recession, is how much earnings will go up. We're already uh, paying a high premium. 2026 PE is almost 26. I mean, that's
I
unheard of. You're paying a 24 and a half for current 12 months, and we're looking for 15% earnings estimate for 25 and potentially a 14, 15 for next year, being 26, which is really far out. And we're basing our price where we are with the S&P, at the 6,000 range on those numbers. If it doesn't come through, we need to adjust.
right.
Not that we won't believe growth is coming, but it might not be here on our schedule. Either way, I think we have a lot of volatility, and I do look for a positive year. Single digits, though, which gives credence to should I go into treasuries or something if I could sit short term, still, 4.2, 4.3 on a 3 month treasury.
Right.
At least from the scenario I'm getting, if it's less than a single digit at this point, what's that risk reward?
Exactly. I mean, I've heard some people say that if the treasuries are paying you the same that the stocks are going to do, are we going to see a migration over there?
We may want to have that talk on March 14th after the government supposedly may close down, but the Treasury should still be able to issue you new paper, hopefully.
Yes, this is true. This is true. Well, I think that does kind of lead us into Magnificent Seven, because that has really been the story. You've been I love your emails, and you've been telling us just how much the Magnificent Seven is actually pushing the market forward. So, you're welcome to talk about that, but I quote you frequently, so our listeners are probably very educated on that already. But what do you think going forward? I mean, we've seen Tesla already drop 30%, right? So it's not so magnificent of the Magnificent Seven. People are talking about Nvidia because it's still going to be great, but it may slow down to 70% year over year growth, and we'll get that result in a couple days too. So, what do you think of the Magnificent Seven for 2025?
First let me say in the video, we'll see what happens on Wednesday after close when we get their earnings. There's a lot of options being played on that, so that could get very hectic as far as volatility goes, no matter what happens in on there. So anyone who wants to trade on there, you really need to be quick on your fingers and be able to do. But the Magnificent Seven is still nice and positive from the election, but year to date, it's down, it's negative. It's pulling away. Without the Magnificent Seven, year to date, you have be up about a half a percentage point. And for February, which is in the red, at least as of Friday, today we're playing, or up about 16 points, it would have been positive without them. So they're pulling back, but the Magnificent Seven as a group, again, we're not talking about Meta, but that's a 20-day run there, they added so much more. If this is a downturn for 2 years of adding over half the gains to the index, this
Yeah.
is the payback. Sign me up. I mean, you got to be kidding. They're still cash positive. Their earnings are not growing as fast as other ones. The multiples obviously is where it's happening, but they are huge, and by a lot of metrics, they're actually cheaper than they were before. Are they hyped? Totally. But as far as going forward on them as a group, I'd rather break them up and actually do issues in there. They're all strong on numbers. The difficulty is they're so high now, especially Nvidia. It's up there, but again, by matrix, PEs and stuff, they're actually more of a bargain now. But as a group, I think I would be a happy camper if they just did their own weight. And realize they're 32% of the S&P 500. In a lot of portfolios, they're more. So they're almost a third of the market. So they've got to work. If I think that the market's going to go up 6%, I think that has to contribute to stay up. Otherwise, they pull it down on there.
Exactly.
Breath has been better, but breath is not that impressive at the moment. Not the last week and a half. Forget about last week, which we saw new highs on Tuesday and Wednesday, and then Thursday and Friday pulled back on there, but breath hasn't moved in yet, to take over where the Magnificent Seven was. The fact that the Magnificent Seven have a limited impact going down, they haven't moved as much because of the variance in there with Apple and some of the other ones, is really a positive item.
Yeah, yeah. And I think we should just point out that, a lot of investors do have it if you have large cap growth. But if you were a conservative investor, you might have missed out on a lot of these gains because without the Magnificent Seven, if you were invested, more on the fixed income side or not at least in the S&P, but definitely if you were missing large cap growth, you might not have had that kind of magnificent performance, at least in a piece of your portfolio.
Right, especially 2024 last year. If you weren't in the seven, one way or another, you didn't get a lot of returns. If you were in fixed income, you slept at night for most of the year. But then when you saw those returns, you stayed up and said, what did I miss? But again, that's yesterday. The market goes on tomorrow. Again, last Friday's Walmart. Perfect example. I mean, it opened up $63 down. Tanking the Dow because the difference in the S&P and the Dow, which is important. A lot of people didn't realize that. Don't realize that. Sorry, I missed the point on that. But you got to know where you're going and what you're getting into on these issues. It's where it trades now. Again, Walmart, the earnings, the sales, the margins were even good. The numbers were decent. The problem was 6, 8 months down the road, and that's where we sell today. It's where you're going to be tomorrow. I cannot buy yesterday's price. I can only speculate on where you're going to be in 6 months from now.
Exactly. Exactly. Good point. And that's why you can have something like Nvidia that's still going to have a very spectacular earnings report that still might not meet investor expectations, right?
It's what the expectations are. When you start paying 60, 70 PE, or if you, we remember, the end of the 90s, you were lucky if you had earnings. Forget about that. It was a three-digit PE,
Yes.
over 100. It's expectations where you're going to be, what you're going to have, and the expected growth. And that's one of my large concerns in the market is that have built in a large growth rate going forward, that 26P overall, and a lot of companies a lot more. And a lot of them are expected growth as compared to services and manufacturing itself.
Yeah. And we should talk about some of the things that might not play out or some of the, we have to definitely talk about tariffs. But before we do, so, you did say maybe we'll have, single digit growth this year in stock prices. Um, but you also said volatility. So when we see a day like last Friday where the S&P dropped 1.71, what do you say to people? I mean, you have kids, so what do you say to them? I mean, I personally am a big fan of modern portfolio theory and regular rebalancing, more than just buy and hold. But what do you say in terms of smoothing out volatility?
Well, my children are both a product of Robinhood during COVID when they just invested and bought whatever they wanted and couldn't believe that I actually work at this. It's so easy. Every day they get emojis about how much they won.
You're
And so,
right.
of course, the market went down. My daughter had 46 or 47 stocks. I didn't even know what they did.
Yeah.
Yes, but for those people, reallocation because the market reallocates for you. So if you want 40% in something, all of a sudden it's going up, something's going down, you end up with 45. So you need to reallocate your position on a regular basis. And if you're youth, and you're younger, especially on a retirement where you're not going to see it for 20, 30, 40 years, you need to take risk and to invest in things, realizing that you're not limited on your time, that you will see bull and bear markets. At my ripe old age, I'm more worried about security and income at this point. So I won't venture into things that I definitely would have done 20 or 30 years ago.
Right.
But people need to reallocate and know what's in their portfolio. That's a big problem
Yeah.
with knowing. Even on passive, you said 32% of the Magnificent Seven is in the 500. You should know that. You're going into a dividend fund. A lot of those are going to be financials and utilities. Know that. Not to say it's good, bad. You need to know when Walmart opened up 63 points down, it took the Dow down 385 points. The Dow, which was down like 350 at the open, would have been positive without that. You need to know that's part of your portfolio and how it is.
Yeah.
And I find that with all the systems and everything, people don't always go through what they have. I mean, within institutions, the risk and knowing what your exposure is overall is important.
Yeah.
Individuals don't always do that. They just say, well, I'm in a technology fund. I'm in a 500. I'm in a growth or value. Know what's making that up,
Exactly.
and are you double counting issues? And does that make you comfortable or uncomfortable?
I think that's a very good advice. I think what also I see with a lot of people is that there is a lot of financial noise, there's a lot of financial gurus, and there's even a lot of fraud. So I think that people have a hard time saying, okay, great, I'd love to know what all this stuff means, but where the heck do I get it? So we can talk about that another time, but I just want to tell people we feel you, we understand you. That's why I'm in business. Howard does a great job, but it's pretty high level for people that are, just starting out. It's harder to understand. But I'm a big fan of data statistics analysis more than, listening to all of the YouTube specialists. Um, no comment?
No, no, I agree. And it's a lot harder for individuals, especially to get information. I mean, we have access to fee-based products that make it so much easier for us to get. I work for, obviously, S&P is a large organization. Pick up the phone or go on Teams. And you're talking to somebody who knows that and everything, and they're telling you things. It's hard for individuals. You see trades beforehand because you can see the flows going in. So you know money's coming here, it's coming from abroad, or it's going back abroad, which is a
Right.
question now, of course. And it's difficult for individuals, especially even though they can get more than they ever could before because of technology and that communication.
Exactly. Yeah.
So can professionals, so can brokers, so can arbitrageurs, so can traders, who just want to make a tick on each trade as compared to whatever you want to buy.
Yeah.
So it's moved up the difficulty to everyone.
Let's talk a little bit about some trends. We talked about that stocks are a little expensive. Um, Listen, there are ways that we can dollar cost average in if you don't have large cap growth or you don't have a breakthrough technology fund or something like that. But let's talk about post-election years because we have seen some extraordinary post-election years. It's complicated a little bit because a couple of them are recoveries from recessions, when I'm looking at it. But do you have any comment on whether or not the post-election year this year will be, part of a positive force for the market?
I would hope it would, but typically the first year, if you go back all the way in time, the first year is not that good because that's all pain. The second year is gain. But if you go back the last 20, 25 years, the first year is when you get the gain. So again, long term and short term are different.
Yeah,
Uh, and this may be one of the worst things to say. This year is different than other years. It's always different, right?
right.
What the Trump administration is trying to do at this point in time is massive. The bandwidth is nothing like it was in 2016 when he's any president. I mean, there's a bill coming up in Congress, which is already approved by the subcommittee, which for reconciliation, which does not look like it may not get through at the first shot, but it does almost everything except delivering me my coffee. And they still have to go through discussion, so you don't know about that. $4.5 trillion in cuts extended. I'm not trying to say good, bad, or anything, but I'm saying the massive bandwidth and impact on it. $4.5 trillion in extended tax cuts. 1.5 trillion minimum in cuts, and that's 880 billion coming from Medicaid, okay, which includes SNAP and some other programs, okay?
Right.
300 billion going for border and defense on there. And these are massive amounts of changes that they are attempting to put through as
Yeah.
compared to typically in all the other years, you pick one item and president and the party goes through it. Then they get a little bit more aggressive. They have all three branches, but nothing like this. This is massive. And that's what I think makes this year different because of the massive changes that can go through. Again, they're trying for one bill as compared to the two-tier in the Senate. And that vote looks like it's going to come up late this week, at least in the House. So I think that makes it different, which adds to more volatility. The more you change, the more volatility. We didn't even mention Dodd, or the cuts there. It's not just
Right.
what's in the U.S. I mean, in the federal government, but all that's supported. You cut a product on defense, it's private ones in there, and then you hit the fixed income on there. So I see a lot more volatility, and I think the American public and investors are feeling more volatility and frustration and aggravation, depending upon which way you look at it. And again, I'm not trying to paint it good or bad. I'm saying the bandwidth here is amazing. What we're trying through executive orders, in the first couple of days, much less, that will be through 100 days, is more than anybody else has done.
Right.
Again, when Trump came in, they were ready to hit the ground running.
Right.
And I don't know if that should be a new trend for the next president, whatever they do, but it's massive.
It is.
And it's volatility. It's hard to keep track of.
Well, if you're thinking about that too, because you talked about the cuts to defense, you talked about some of where some of the cuts are going to be going, which obviously is going to be negatively impacting those industries and those companies. Also, if we do have a lot of layoffs, that could make unemployment go up a little bit. That That's going to be an interesting situation as well. But let's talk a little bit about that because we have a lot of debt, not just in our federal government, but also in our corporations. Our consumers have a lot of debt. So, do you have a size or style favorite going forward, or do you think the best plan is just one that's very diversified and age appropriate?
Let me first hit on that debt item on that bill that's coming up. Also, adds $4 trillion to the $36 trillion debt. It takes care of that as well. uh, I'm sorry. So your question again was
Size or
on
style? Like, given what you're seeing, especially on the policy level, but also the impacts that that could have on certain industries, should it go through? I mean, we should probably see some cuts go through. It may not be as much as they want. Do you have a size or style preference, or do you think that
yeah,
people should be a little bit concerned about this or that industry?
yeah, I do. Obviously, I have somewhat of a employment bias towards the 500.
Right,
Even though I created a small. Because they have better liquidity. They have more diversified products typically. They can get more financing internationally as well. And I have concerns for smaller companies when tariffs come in. A lot of the larger companies write contracts, like Apple writes them in US dollars,
right,
okay? Which can help when you're a small cap company. If the dollar goes with you, the way it's been going, you make a couple of extra dollars. But if the dollar goes against you, you can't, you've got to either pass it on or absorb it. So I think from a more risk reward basis, I go towards the higher caps. However, you don't have to stay in the weighted cap type. I mean, you can go equal weighted, which we've seen a lot of inflows into equal weighted indices, not just the S&P 500, but
right,
other ones in there because they feel that the breadth will improve. The economy will eventually get better. We're not sure how much, an overall optimism, and it'll spread across. And therefore, those that did not do as well previously, the non-seven, the non-technology issues, they will catch up. And we're looking for that, for breadth. But as far as small caps go, they are a success story waiting to be written. Over the last year, we've seen two huge inflows in the market go in there. When I say huge inflows compared to what the small caps are. For the big caps, they're not. They got companies got away from technology and they went right into small caps. And what we've seen is that they go in, small cap goes up sometimes a double digit over a short time period. But then the companies pull out if everyone else doesn't join in. Okay. So they
right.
want to go into small caps because over time they do better. If I
Yeah.
go back 25 years, but they haven't been recently, definitely not. So you want to go in there, but you're not sure of your timing. Timing is the hardest thing to do in a market. So we've seen two instances where they've gone in and then pulled out. They are ready. That finger is on the system. They will go back in the minute they think it's ready. But if everybody else, mom and pop, doesn't join in with them, they'll get out again. But that is definitely a success story. But you know, we've known that for over 2 years now. It's a long time to sit in a sub performing group. So again, that's a time. So again, I'm in big cap, but small cap. At some point you're going to look at me and say, "Wow, that was quite a run back," but it was payback for the underperforming.
Exactly. Exactly. And I like you did two very important statistics there that I just want to kind of punctuate for you a little bit as well, more for our listeners. First of all, you had mentioned that the S&P 500 is very liquid. And I think that's what a lot of people don't realize is that certain things are just have more volume than others, right? So like I was looking at a liquidity chart and the difference between even just the S&P and the Dow Jones Industrial Average, it's massive, right, in terms of liquidity. And the other thing too is that you're saying, hey, large caps are where it's been all the time, but small caps you might want to consider adding or looking at again, right?
Yeah, small caps is a timing situation. Not every investor has a 20, 25-year perspective. Even my kids want it a lot quicker in
Yes,
their
this is true.
retirement accounts
Are
on
you
it.
kidding? Even my kids, they want it in 20 minutes. What about Trump tariffs? Who wins and who loses in industries? Like if we do want to go for, let's say, for instance, that we want an industry that might hedge in case the volatility is a little too much for us to stomach, right? Is there anything that's going to be immune from Trump tariffs? Are there any industries like perhaps auto manufacturing that actually might have a worse time of it? What's your 2 cents on this?
Okay, first of all, if tariffs are when tariffs go through, it will impact everyone. It's not necessarily who's a winner or loses, it's who doesn't lose as much. Right now, all we have is the 25% on aluminum as well as steel. The 10% on China, which they retaliated slightly with, is looked at as just negotiations, as are most of these other things. They're negotiations. We do not know where it's going to end.
Right.
Okay, where do you get that candidate? The only companies that have actually warned on their earnings, and remember I said those earnings are really high estimates, they don't include tariffs on there. Any
Interesting.
impact, we're going to have some. Autos have warned, and Ford has been vehement about it, coming out public very strongly, that how much is coming from Mexico, how much is coming from Canada, and I can't pass on 18 to 25% cost to the
Makes
customer. And if I do, how much are they going to buy? The imports on China obviously hurt on there a lot. So we don't know where this is going to end up, what the bottom number is. But what we do know is certain things are there. You can assume that you're going to continue some kind of tariff situation with China. Okay, they had the 25 went down at the beginning, you had the extra 10, you add some more. That speaks to small stores that have things coming in small parts. The dollar stores, as an example, Dollar Tree, all those little things with chopsticks, all those little items are difficult to go on there. So they have a big difficulty. Made in the USA is nice, but the costs are going to go up. So the question comes up, how much can the company pass on to you and how quickly can they make up for the product? We've seen a tariff probably on lumber coming in. We can't build the trees behind you too quickly. It's not something that a company could do in a month or 2 months. We're dealing 20, 30 years down the road.
right.
So these things can't be replaced. They're going to be passed on to consumers, which are inflationary. If we get higher unemployment, and we're 4.1 now, anything over the 5% number, which traditionally is not that bad. We're not talking about Jimmy Carter times.
Right.
Will start to impact people, and we've seen sentiment goes down. Consumers and investment sentiment has gone down significantly. And if I feel like I'm not secure, I am not going to be spending. If I do not spend, the company does not get the income. So the tariff main impact is on consumer sentiment. If I feel my job's secure, I'm making money. I don't know how I'm going to pay that extra 15%, but I'll buy a small car. I'll go on vacation a little bit differently than there. I'll manage through it. But if I have concerns, even if I'm making more than I did last year, I've got to put a little bit away because things change quickly. So
Yeah.
the tariffs, again, still in motion. They're still being negotiated. We do expect them to come in. There'll be some inflationary items, but it's a combination of how much more push to consumers and how consumers are with employment.
Well, and that brings up my next question, which is, with inflation not coming down to where the Feds want it to be, we've seen that the interest rate cut expectations are maybe 25 basis points this year now, right? That's not a lot. So what about that in terms of commercial real estate or some of these other industries that may need to roll over and refinance some debt?
Not just commercial, but also retail. I'll preface my statements about REITs, because that's what we follow, real estate investment trusts. Again, they could be commercial, but they went through a large refinancing in the fourth quarter, and they got through it. A lot of it was short term. We look for this year also to be difficult. Again, there's a lot of refinancing in the second half coming into these companies. Okay,
Yeah,
we're not even talking about occupancy variation between an A building, which has long-term tenants, and let's say a C that's half empty on there. There's
yeah,
a lot of financing needed the second half of this year on most REITs, and any increase from where they were, with the bridges loans in there, is going to hurt them. They do not want to sell most of their property because one, that's your business, and
right.
two, if you have to sell it, it's probably at a depressed value. So you're taking
Exactly.
a double hit there. My income going forward, I'm going to have to readjust, whether it be actual cash or net present value, and my asset is now diminished. So yeah, the second half on interest rates, but looking ahead, you know, 5, 6 months from now, I mean, I want to get past, March, February, even here. There's a lot in motion. Again, that bandwidth is enormous. So many things can change, and that has created a problem for a lot of companies that we talk to, at least. It's hard to make plans if I don't know what the future is. Give me the worst scenario you have. You want 10%? Take a bank test, for the Fed. 10% unemployment is going to be, REITs go down 32%, whatever you want, and I'll make a plan for it. I've got to do this, this, and this. But there's so many branches on the tree now. It's hard for them to do. The only thing that we do know the expenditures are there is capital expenditures. That will easily be a record this year. And one company's capital expenditures is another company's income. So that
Exactly.
helps a lot. And it's AI spending, not necessarily staying on the chip, but everything it brings too. I mean, I use AI almost every day. It starts me up with stuff. It's not thinking, but it's starting me off with that better spreadsheet. It's connecting 3 dots instead of 2 dots. And
Right.
it's footnoting everything. The similarity is to like when we first went on to Lotus and then Lotus to Excel, it enhanced the speed and ability to do things. It didn't think, but it goes. So capital expenditure is one of the main items that we think will increase this year no matter what. But not sure that it's enough depending upon what consumers. Oh, we also dividends. I know that's a change there. I'm looking for about an 8% increase this year in dividends, another record year for the amount you actually got paid out.
Wow.
And buybacks look like they're going to come in. And buybacks support the market, remember. It's more
Exactly.
buying in there. It doesn't mean that you've got a good stock or not, but more buying, pushes it up and supports it.
Yeah, yeah. I think this is all really valuable. Thank you. I also want to talk a little bit about financials and insurance companies because not only are they the ones that are holding a lot of the paper for the commercial real estate, but they also, we've seen, have had to have a little bit of the paper losses on their long-term assets, which isn't improving a lot this year as well. So, what do you feel about those two industries in terms of financial services?
That's something that obviously I'm on the equity side, so everything I say is in reference to equities as
Yeah.
compared to like S&P ratings, which I'm not part of, and rarely will talk to me
Yes,
on there.
yes.
Okay, so we did not see in the last round of earnings, obviously, a large increase in the bad debt exposure.
Okay.
The concern on there. We saw it pick up in the credit cards and definitely on the car loans, with the duration going higher. But there wasn't a major increase on there, which is very positive at this point that they're managing it. Again, when it comes down to the REITs and all those ones that they're going to have to refinance, the difficulty on the lower end more than the higher end. And this is the difference between an A building and a C building. Well, A building usually has more amenities, but it also has long-term tenants. The building I'm in, S&P downtown, we have several floors closed. I mean,
Mm,
I go to the brokerage houses and some you can set up a golfing course in there, okay? But they're there, that their companies are good, they have cash flow, they're paying their rent, okay? New rents coming up are much lower, but they have open space there, and they're paying the rent. So those buildings are able to manage their cash flow. Lower down, when you get tenants that are individuals or signing for 1 and 2 years, the old WeWork type, okay, before
yes,
they went into WeWork,
yes, yeah,
got into a lot of difficulty because all of a sudden I have a building that's 20%, 30% empty. Okay. My building may have a comparable amount of empty floors, but they're being paid for it. So I think on the finances, you've got to differentiate with them, the higher end to the lower end, which is basically cash flow to non-cash flow. You also have to differentiate if you go into the mortgages, like your kind of Wells Fargo's and those, what they're doing, how much is on the lower end that will have to be sold on there. Again, housing is difficult today. The prices are higher. The supply is still not good. The housing starts again at 9.7% in January. The ratio that we use for to buy a house, income to cost is still very high, very difficult.
Yeah.
So you really have to go into the individual issues on there, or look for a fund that deals more in high-end quality or low-end quality if you want to take that risk-reward scenario.
Right.
But when you go to the whole group, this will get me in trouble. You go to the whole group, it's like going into healthcare. There are going to be some nice winners there, and there's going to be some nice losers. So the group may even out,
Right.
which is okay. But if you're looking for individual stocks, there's a big difference between the top and bottom here.
Right. So I guess what we would say is funds protect you, right? Having a fund that has more companies in
Yeah,
it protects you.
but also it does not give you that winner. It does not give you that big loser. So again, it's risk reward on there. And it depends what your portfolio is. How much do you want to, if you're younger and you're in duration, especially if you have retirement money where there's no tax impact,
Right.
you may want to put a portfolio, just like you would say, I want so much in gold, or I'm going to do so much in crypto. Put some into a riskier item for a higher return, because your tolerance should be higher. Again, as you get more mature, older, you may not want that kind of volatility.
Right. Or at least
You,
a little smaller slice of it.
right, right, you look at it differently on there. So again, the port, no, even if you have someone who's managing your money, the important item is that you need to be truthful with yourself about how much you're willing to lose. I know you're willing to win everything, but
Right.
how much you're losing. If you do not tell that to your advisor, they're working under a different premise. Everyone I know wants to make money, but when it starts going down, they don't. Or they get irrational. I'm waiting to get my money back. Okay, you're down 20%. You could be down 30, but you buy it today. So an important question I think is to ask, if this is what you hold, forget about what you bought it for. Would you buy it today? If you wouldn't buy it today, you better be able to convince me why you're holding it. Again, and people aren't always, professionals as well, you're not always as honest with yourself as you should be. Sometimes you just don't realize it,
Yeah.
until you're in a situation when you look at your brokerage statement and say, where'd my money go?
And there's something I wanted to kind of circle back to, because you talked about capital expenditures being positive, but then you also were kind of folding it in, especially into AI, especially again into
Oh,
technology, right? So that's feeding again more and more into the Magnificent Seven, into the large cap growth areas. So again, guys, we're just saying you better make sure you have a little bit of that, right?
yes, but it's starting to filter down, and it looks like capital expenditures overall, if you subtract out AI, it's hard to get last year's numbers. We have a lot of suggestions going forward because companies have mentioned it. But it looks like the capital expenditures might actually be flat or down without AI. But the AI is not just in the manufacturers, it's in companies that could utilize it. My company uses it. I see talk and see demos with insurance companies. All those number crunching that take the extra step and go beyond, those are doing it.
Yeah.
Fast food, the joke about I'm doing a drive-through and I'm ordering to someone in Hong Kong. Well, now I'm ordering to a system. I mean, all these companies are doing AI work. They're not
Yeah.
producing it, but they are getting custom-made software that permits them to improve the productivity, and that's one of the main items that at least after tariffs, we see in estimates going forward, higher productivity, partially through AI, and that will make up a higher inflation cost and higher costs by people. So higher productivity is a main item that's sustaining us going forward. And when we talk about AI, but AI filters down. The computer makers, they made money when they made it, but when it got down to my desk, look at what I'm starting with, and look at all the things you do now with it. And it will be difficult and painful for a lot of groups. Any kind of automation displaces one and starts another.
Yeah. Yeah. Okay, so final thoughts, Howard. Thank you so much for your generosity of time here and always your wisdom. Final thoughts that you might have for, again, we're talking mostly to Main Street investors here.
Know your tolerance and your risk, what you're willing to make and what you're willing not to take, what you can play with, okay? And take a risk with as compared to no, I need this to my kid's school, my house. If I'm 25, 30, trying to buy a place, or I need this, for my kid's college, or I need this for my retirement. You need to know what your tolerance is, and that's important. I mean, and then if you're not as secure with investing it yourself, you need someone who you can trust, that's friends and people. Obviously, indexes are good that they consolidate and they do reduce your risk, okay? But it's not as good as having that one winning stock that doubled and tripled every time. But you're not going under. Again, risk reward, key, I think, item. There's a AAA bond, doesn't pay a lot. You want a lot more, get a single A or go into a double B, a lot more risk. You need to know yourself. I think that's an important item for people that are investing. It's not as easy as you think.
But not as hard if you finally learn the life math that we all should have received in high school. And right. And maybe you start
Longevity.
learning, I mean, look, there are resources out there. Of course, I'm one of them, but there are others too. Like if you didn't understand all of the words that Howard just said, there's Investopedia is really good, has really good definitions. Start learning the language, right? I always say, on one side it could be easy to put you to sleep, but read the Fed minutes and start learning how to understand that a little bit more, So start speaking the language, people, and then you'll be surprised at how much more you can learn very quickly, rather than just relying on gurus who may not even know as much as you do.
The education is key, and uh, I'm a big supporter in starting that in the schools, and I don't mean college. And I mean, there's no reason that I know that you don't. The equivalent of balancing your checkbook should be in junior high school. Nobody has a checkbook anymore, but you should know how to balance your Venmo, where the money's coming from, and how you're doing that. And a lot of people don't, unfortunately. And there's more on individuals there. They have to do their own 401k, their own health care, it's all on you.
Yep, and there's a lot of great solutions. So thank you, Howard. Really, really good stuff, really good wisdom. And wherever you are in the world, I hope you're having a good time. And I guess you're not freezing like I am here in New York City.
No, no, no. But next week I will be, but not this week. This week I'm on the beach.
Oh, quel dommage. Okay, au revoir.
Take care.